Greetings everyone, Francis Fernando here. In this episode, I would like to cover a very important topic known as depreciation recapture. Now, I will hit a little bit of background about what depreciation itself is. Depreciation itself is the process by which the IRS allows a real estate investor to take an expense year after year right on their operating statement or on their profit and loss statement, take that depreciation expense to offset any gains. So it is a positive. You've heard me tout how positive depreciation expense is. It's one of the tax benefits to owning investment real estate. It reduces your taxable position because every single year you get to take this beautiful expense known as depreciation and you deduct that right from your profit and loss statement. The way depreciation actually works, or the way it's calculated, is that the IRS takes the land value and separates it out of the property value. So you get the real estate value, you separate out the physical property or the physical asset from the land value. That physical asset is then allowed to be depreciated over 27 and a half years. So you take that physical asset value, divide it by 27 and a half, that's going to give you the number that you can depreciate and take off of reduce from your taxable income from the profits of that real estate asset. So it's a huge positive, the fact that you can do the depreciation. The importance comes when it is time to sell the property. So when you're selling the property, there is a process by which the IRS comes back knocking on your door looking for this thing known as depreciation recapture. And that's what I'm going to explain. So depreciation, just to give you an idea, let's just use an example of a cost basis or purchase price of $100,000. So you purchase a real estate asset that it's greater than $100,000, but you have attributed that the physical asset, it's really important to know, not the purchase price itself, but the physical asset of that real estate separated from the land value is $100,000. The IRS then allows you to deduct every year an amount of roughly $3,600. I believe the exact number of 100,000 divided by 27.5 is $3,636. So to be exact, it's $3,636 that the IRS allows you to deduct on a yearly basis, which is beautiful again. Now, what happens is, that's your yearly depreciation. What happens is, at the time of sale, the IRS is going to calculate where your cost basis is in relation to your sale price, where your adjusted cost basis is in relation to your sale price. Now that is super important because most people, including myself for many years, assumed that I get taxed, that the government taxes me on the difference between my purchase price, my raw purchase price, and my sale price. Unfortunately, that is not the case because that's a smaller margin. Assuming you sold the property for a profit, the adjusted cost basis is going to be significantly less based on how many years that you own the property and how many years you took the depreciation expense. So the reason why I say it's really important to plan is because there is a way that you can actually increase your cost basis, your adjusted cost basis. So you can increase that by capitalizing certain expenses, certain qualified expenses. So throughout your ownership of that asset, you can as you make improvements on the property, you can raise the adjusted or offset the depreciation by raising the cost basis. Because if you put a capital improvement into the property, or a capital expense, if you have a capital expense, it actually raises your cost basis. So let's just assume that you purchased the cost basis is $100,000. On year one, you took a $3,600 depreciation expense, but at the same time, you had a $10,000 roof replacement. Well, your cost basis is actually going to be $100,000 less $3,600 for depreciation expense plus $10,000 for your roof expense. So it's super important to understand that. So at the time of sale, and that's the purpose of this episode, is at the time of sale, what happens is, again, like I mentioned, most people assume that your taxable income is based on the difference between your sale price and your purchase price. Unfortunately, that is not the case. Your taxable income is based on your adjusted gross income versus your sale price. And so that taxable income then is actually broken up into two components. The first component, the difference between the cost basis and the sale price, is your capital gains. There's a certain tax rate for your capital gains. And then the difference between your adjusted cost basis and your cost basis, that difference is known as your depreciation recapture. So super important to understand that. I know this, for those of you that are watching this on video, you have the opportunity to see this. For those of you that are listening to this on my podcast, I will make sure that my main screen capture, or the title of this episode, actually lists this image so that you can utilize the image to better illustrate the difference between your adjusted cost basis and your sale price. So I know this is a valuable, important lesson for you. Again, it takes some planning when it comes to real estate investing. It takes some planning year after year with your tax accountant. Make sure that they are capitalizing, or at least ask them the question, hey, I want to make sure I take the depreciation expense because that is a super positive, but at the same time, I want to make sure that I categorize some of my expenses not as pure operating expenses, but as capital expenses. And that's going to help sort of keep that adjusted cost basis in check. So when it's come time to sell, you're not going to be hurting for a bad taxable situation that you're going to be in. Thanks so much.